Hi everyone, and thank you for joining the latest in our series of videos about ARIE Capital and its latest technology EIS fund. We are talking today with ARIE Capital Chairman and Co-Founder Stephen Margolis in London. And Stephen, we wanted to talk today a little bit about exits. So maybe can you start just by explaining to us what an exit actually means and different types of exits that we see in the industry?
Well, the exit is the way that the investors actually get their money back. And it's called an exit because they will be exiting from the investment. There are typically three ways that an investor exits. One is the company goes through an IPO, it's floated on a stock exchange, and they can sell their shares during the flotation. Another way is when somebody else is investing in the company and they want to buy the EIS investors out. The final way of an exit is when the company is taken over. I think that's the most typical way normally. Bigger company comes in, likes what they see in the startup, and they buy all the shareholders out.
Great. And at what point in your relationship with the company do you really start thinking about the exit strategy? Is that something that you really only think about a few years down the line once you're actually working together, or at what stage do you start talking about that?
Actually, Ricky, it's on the contrary. The exit strategy is normally discussed at the very first meeting we have with a potential investee. It's very important to us that we are completely aligned with the management, and that they are prepared to consider and understand that the investors will want to get their money back in a 3 or 4 year time period, and that we are working to a defined exit strategy.
So it sounds like that the founder should be thinking about an exit strategy really from the earliest possible stage, and it's something that you're already discussing with them even from the earliest moments of evaluating a startup. Is that right?
That's absolutely right. We're not investing in what I call lifestyle businesses where the founder can sit there and just use the investor's money to keep the lifestyle of the founder. The founder has to be reconciled and in line with us and our investors that he's going to sell the business in a 3 or 4 year timeline, or get somebody to invest in the business which will buy our investors out.
Great. And when we look at the track record of ARIE Capital over the last few years, are there any examples of exits that you can share with us and how that experience was for you?
On the EIS side, we were very fortunate a couple of years ago to sell a company to Google and gave a multiple return to our investors. And on the VC side, we've got a couple of companies in the process of an IPO, which should be completed by about April, May time.
Very exciting. So it sounds like the exit scene is as strong as ever for ARIE Capital and the VC and startup landscape as a whole. So thank you so much for talking a little bit about exits for us today. And for anybody that's interested in ARIE Capital and its latest technology EIS fund, we will put the fund website in the notes section below. Thank you so much, everybody, for joining us.